Today we are going to cover financial instruments. Imagine this. You're scrolling through your social media feed and you come across headlines like 23-year-old makes billions on Coca-Cola investment or this startup raised millions overnight. These stories make headlines because they highlight how people and companies use financial tools to grow their wealth. But behind every success story is a series of smart decisions involving financial instruments, the tools that allow individuals and businesses to manage, borrow, save, invest, and grow their money. You have probably already used some financial instruments in your life. Let's take a moment to reflect on some instances where you have interacted with some. In this lesson, we are going to break down what these instruments are, how they work, and why they matter, especially as you begin to manage your own finances. Let's understand what are these financial instruments. At their core, financial instruments are contracts or agreements that represent some kind of financial value. Think of them as tools that help you achieve specific financial goals. For example, if you want to save money, you might use a fixed deposit. If you want to invest in a company's future performance, you might want to buy stocks. Financial instruments help you save, invest, borrow, and plan for the future. There are two main categories of financial instruments. Understand these tools as they are essential and offer different levels of risk and reward. Whether you're looking for stable returns or growth, financial instruments help you achieve your financial goals. Let us understand what are debt instruments. Most of us have heard that people lend money for a return. So, a debt instrument is exactly what it sounds like. It involves debt or lending, which is essentially borrowing and lending. When you invest in a debt instrument, you're lending money, and in return, you earn an interest over a specific period of time. Let's understand what are bonds. The classic debt instrument is a bond. This does not mean James Bond, but a debt instrument. A bond is one of the most common debt instruments. When a company or government needs money, they can issue bonds to raise funds. When you buy a bond, you are lending them money. In return, they agree to pay you interest, sometimes annually, sometimes semi-annually, and tend to return your original investment amount called the principal. Here's a simple example. Imagine you buy a 10,000 bond from the government that offers 6% interest rate per annum for 5 years. Every year, you get 600 rupees in interest. This 600 is calculated as 10,000 into 6%, right? Which gives you 600 rupees. For the next 5 years, you would tend to receive the 600 rupees. So in year 1, at the end of the year, you would receive 600. In year 2, you would receive 600. In year 3, you would receive 600. In year 4, you would receive 600. In year 5, you would receive 600. But at the 5th year, you would also receive your principal back. That is the entire 10,000 rupees. Now, it's not essential that all bonds will repay your principal. Government bonds are the trust which is assimilated with the government of the country because the central government can print currency. There's a guarantee that you will get your money back. Bonds typically are often considered as low-risk investments, especially government bonds, because they tend to provide steady returns and we are always ensured or assured that we are going to get our capital back. This capital is also called as your principal. The next type of bond which we are going to discuss are corporate bonds. These bonds are issued by corporate houses, also called as companies. These also work in the same way, but usually offer higher interest rates compared to the government bonds because they involve slightly higher risk than government bonds. Now you can understand a government can print currency. However, companies are not allowed to do so. So the risk involved for repayment is higher. Companies might default on payments, which is less likely with a government bond. What do you mean by default? That means I do not pay interest as well as the principal amount which has been invested in the corporate. Another thing you should be wary of is most of these corporate bonds have credit ratings. Credit ratings is very similar to a structure of your grading system. So for example, if a student scores an O, in corporate bond parlance, it can mean a triple A, a double A plus, and so on. The moment I have a triple A bond or an O grade, it implies that I'm a well-performing student in case of a grade, and in case of a triple A bond for a corporate level, it means that the company is performing well and can repay its interest and principal on time. So in subsequent modules, we will be covering what are credit ratings, what features does a debt instrument carry, how does market interest rate affect pricing of the bond. Now let's move on to the next debt instrument, which is called as a fixed deposit. A very simple and secure method to invest your money. You've probably heard about the term deposit, fixed deposit, a short form as FDs. Specifically, if your parents or older relatives talk about saving money. FDs are a type of debt instrument where you deposit a lump sum in a bank for a limited period of time. This period can vary right from 10 days to probably 10 years, and the bank pays you interest in return. Now, according to the bank norms, up till 5 lakh rupees is assured by the deposit insurance schemes, which is being set up by the government, whereas any amount greater than that in a single bank is not assured. So you should be cautious. If you want to understand what amount is assured in various formats, you should actually read the link given below. Now let's understand what is a debt instrument. Debt instrument involves borrowing and lending. When you use a debt instrument, you lend money and are repaid interest with principal at the maturity. Interest is typically paid during frequent intervals, probably yearly, semi-annually, quarterly, based on the type of instrument payment you are opting for. Examples of debt instruments are bonds and fixed deposits. Now let's move on to the other side of the spectrum. Let's understand what are equity instruments. These are also a form of financial instruments. In case of debt instruments, you never became an owner of that bond or a corporate bond. Corporate bond at times may be also called as debentures. So please do not get confused when you hear the term bond, a corporate bond or a debenture. Bond typically is used in the parlance of government. Corporate bond is for corporates and debentures is also for corporates. Another anecdote for you is whether it's a financial institution other than banks, they are also corporates. For example, it may be an asset management company. For example, it may also mean it's an NBFC, a non-banking financial company. They are also corporate houses who are allowed to raise money through debentures or corporate bonds. So do not get confused on that. Now let's move on to the other spectrum, which is equity instruments. On one hand, debt involved lending. You became a lender. Your status was a lender, whereas equity instruments makes you an owner. Not a full owner of a company, but probably a part owner of a company. When you invest in one equity share, you own a part of a company because the number of shares that may be issued by a company may be quite large. So, if you own a drop in the ocean, it doesn't mean you own the ocean, you own the drop, but you are called the part owner of a company. And you also are eligible to share the profits of the company. But the company is not liable to share profits with you unless and until they decide to share it with you. The form of profits that a shareholder receives, the moment you become an owner, you are called as a shareholder on the books of the company. You will receive dividends if the company agrees to pay you, right? This is the share of profit that you will receive. Typically, dividends are typically paid on the face value of the share, and dividends are paid out of the profit. This is something which you need to understand when you are going through equity ownership. Not all companies pay dividends to their shareholders. Some companies do pay dividends on a yearly basis. Specifically, if companies are in the growth stage, they will tend to redeploy their cash and profits into the business so that it continues to grow. However, more detailed discussion on this will happen in subsequent modules. This is just to give you a feel of what are equity instruments. Now let's understand the contrast between a debt instrument and an equity instrument. For example, if you deposit 50,000 in an FD with a 6% interest rate per year, you will earn 3,000 by the end of the year. You will earn 3,000 by the end of the year. FDs are popular because they offer guaranteed returns and are low risk because there's a guarantee by the government that you will receive your money back up to a certain threshold. Once you deposit the money, you can't access it unless and until the term ends, making it a disciplined way to save your money. It's not a way to get rich fast, but it's a great way to build stable savings. Equity instruments. Let's look at owning a piece of a pie or a piece of a cake. While debt instruments are about making you the lender, where you're lending the money and getting it back with interest and principal, equity instruments are about making you a part owner. When you are buying an equity, you purchase a small part or piece of the company and you share its profits in terms of dividends. Losses are typically not passed on to the shareholder. This is where the risk comes in, but it's also where the potential for higher reward lies. Let's understand what a stock is. Whenever you have a number of shares which are cumulated together, it's called as a stock. A single share is of a particular company. Stocks can be of multiple companies where you add them all together also, or it can also depend on a single company. Investing in companies. Stocks are also known as shares. They are also known as equity instruments. But when you buy a stock, you're buying a piece of a company or a part of a company. They also call you as a partial owner. If the company does well, the value of your stock increases because as an investor, you assume that the company's performance is going to drive the value of the share. And you might also receive a share of the company profit if the company declares a dividend. A company is not bound by law to declare a dividend every year. It is their prerogative whether they wish to declare a dividend or not. However, if the company does poorly in terms of making very poor profits, the value of your stock could typically decrease. This is typically found during result season, where you will find that there are certain analyst reports which come out and they tend to envisage that the profit level should be X, whereas the actual performance of the company may be Y. If the performance of the stock, that is Y, is greater than the analyst expectation of X, it means that the stock price will typically go up. But if the performance is lower than the analyst expectation, the stock price or the share price will typically go down. This is not the only sole reason why the share price of a particular stock goes up and down. There are various other events that occur in the market. There are various other decisions and global market influences which affect the stock price of a company. For example, you may pick up a company which is into steel business. The raw material that is there is steel. So what typically happens is if steel prices go up and down, it will also affect your stock price because raw material traditionally will impact your profits because you have revenues minus your expenses, which gives you profits. If the expenses go up, that is your raw material prices go up, your profit will eventually reduce unless and until you are able to make that benefit into your revenues, right? Now let's look at another example. Let's say you invest 10,000 in a company like Tata Motors. The best part would be, please check up what is the share price of Tata Motors today and see how many shares you would be able to buy with that 10,000 rupees. If the company like Tata Motors performs well and its stock price increases by 10%, your investment will be 10,000 plus 10% of 10,000, which is equal to 10,000 plus 1,000, which is equal to 11,000. However, if the company is struggling with raw material problems, or probably if the company is struggling with labor costs, then your investment value might shrink. Stocks are generally considered higher in terms of risk, but they also offer the potential for higher returns over a period of time. When picking individual stocks, it sounds risky or overwhelming. But there is a more safe option which you can go for. By safe doesn't mean that they are less risk, but instead of you picking the stock, you have a professional fund manager who does the stock picking. These are typically mutual fund houses where you have a fund manager. They select an assortment of stocks, which is in turn a scheme. They are governed by the SEBI in case of equity. They are governed by both SEBI and RBI if there is a debt mutual fund. So, equity mutual funds are governed by SEBI. Debt mutual funds are governed by RBI and SEBI. So, let's understand how does mutual fund help an individual investor if you do not have an idea of how to invest or how to pick a stock in the market. So, if you are a beginner, you could actually choose a mutual fund where you have a professionally trained person called as a fund manager who will ultimately make sure that he or she selects the set of stocks based on the objectives that are desired, right? Now, let's understand how does a mutual fund scheme operate. So, what typically happens is a mutual fund pools money from individuals who are investors, and the fund manager along with his research team decides to buy a diversified portfolio of stocks. The diversification may be based on a number of parameters. Let's begin with pure equity schemes where they only invest in stocks. There are also a mix of schemes which are hybrid where you invest in stocks and bonds and other securities. So, it depends on what kind of a scheme you choose. So, mutual funds can be large cap. Let's discuss only equity. You have large cap mutual funds. schemes, you have mid-cap mutual fund schemes, you have small-cap mutual fund schemes, you have flexi-cap schemes, you also have focused equity schemes, you have index funds which are passive. The prior ones other than the index funds are all active fund schemes, where a fund manager is actively involved in beating a benchmark index. Now, many of you may not be aware of what's a benchmark index. We will discuss this in detail as we go forward in the sessions. Let's understand the next step, which is by investing in a mutual fund, you're essentially buying a small share of many different companies, which helps spread the risk. But this does not make you the owner in the company. Whenever you are investing through a mutual fund, you just become a unit holder. You do not become the owner of a share. So I can never say that I'm a part owner of the company because I own 0.1% of the share. We don't. So it's very different than stock picking. You're not doing stock picking. Plus, you do not become an owner, you're just a unit holder. In addition to that, you will pay expenses to the mutual fund house for handling your money. The benefit of investing through a mutual fund scheme is that there's already a professionally trained fund manager who's going to handle the decisions and stock picking. Diversification is typically helping you break down what companies or sectors may be doing well, and it also helps you to figure out what mix of companies should be picked up. So diversification is typically to not keep all eggs in one basket. So even if you have large cap stocks, for example, the index that we also have is Sensex and Nifty. A major part of the index are banking and financial institution stocks. So in addition to that, you can also probably pick up an FMCG company. You can pick up some other IT company. So that's how diversification comes in, because you are trying to diversify the kind of companies which you're putting in. Diversification can happen at stock level, at sector level, and various other levels. However, diversification is not part of this particular session. We'll cover it in a subsequent session. Let's understand how a mutual fund might involve a combination of companies like Reliance, Infosys, ICICI Bank, Axis Bank, or probably Kotak Mahindra Bank, HDFC Bank, and some government bonds. So if one company underperforms, the others might do well. So your risk is spread across the entire portfolio. Mutual funds are managed by professionals, as I've already indicated. So you don't have to worry about constantly watching the market yourself. For example, sometimes you may lose more than 2000 points in a day. In such a situation, you don't need to pull your hair. The person who's the fund manager who's taken the stock pick knows the story behind it. They may be value-based investors or fund managers. They may be growth-based fund managers. And dependent on their styles of investing, they will select the stock that has to be taken up. By investing in a mutual fund, you're essentially buying a small share of many different companies, which helps you spread the risk. Let's understand how do we spread the risk, which is also called as diversification. A mutual fund might invest in a combination of companies like Reliance, Infosys, ICICI Bank, Kotak Mahindra, Axis Bank, and so on, as well as some government bonds. If one company underperforms, the others might still do well. So your risk is spread across the entire portfolio. Even if the banking sector underperforms, there are other companies to support the performance of the portfolio. Diversification helps us in numerous ways. We will understand the different levels of diversification in the subsequent sessions. Now let's understand how professionally managed mutual funds help us remain worry-free. Since mutual funds are professionally managed, one doesn't have to worry about constantly watching the market yourself. For example, if the market goes down, by market I refer to either of the indexes such as Sensex or Nifty, goes down by more than 1000 to 2000 points, the entire market tends to remain in red. That means all the stocks which are trading in the market tend to largely trade in the red. That means they have made losses. So it becomes very difficult and many a times impossible to monitor all the stocks that we have invested in. Simultaneously, many a times people tend to panic. This is also a side effect of not knowing what is happening in the market. Warren Buffett famously called derivatives financial weapons of mass destruction because of their complexity and the risks they can carry. While they can be useful, they are generally not recommended for beginners due to their potential for significant loss. Why should you care about financial instruments? As you start managing your own finances, understanding financial instruments will help you make smarter decisions about saving, investing, and growing your wealth. Whether you want to start small with a fixed deposit, which is safe, or explore the stock market through mutual funds, which is professionally managed, financial instruments offer a range of tools to match your risk tolerance and financial goals. Imagine planning for your future after graduation. Maybe you want to save up for a car, invest in a business, or just start building a nest egg for a long term security. For example, retirement, early retirement, or something called as FIRE. Knowing the difference between a bond, a stock, and a mutual fund will help you decide where to put your money so it grows in line with your ambitions and goals planned out. Financial instruments aren't just for finance professionals. They're also for anyone who wants to take control of their financial future. Whether you're risk averse or prefer steady returns from debt instruments, or you're ready to dive into the world of stocks and equity, these tools are your ticket to financial independence. As you move through this course and go deeper in your financial journey, always remember that financial instruments are just tools. How you use or deploy them depends on your goals, and they are an important tool for people looking to grow their wealth in the long term. Warren Buffett, one of the world's richest men, built much of his fortune by carefully picking stocks in companies. His tolerance for risk and his willingness to learn has led him to consistently build wealth over a long period of time. However, most of the times when we take a look at his wealth accumulation, it has occurred post his 50 or 60 years of age. That does not mean you cannot accumulate wealth at an early age. But always remember that power of compounding helps. Once you invest, keep a tab on how your investments are performing, that is, monitor your investments, but does not mean that you keep on withdrawing money as and when you need it. The basic fundamental is to stay invested if the performance is good. Start small, ask questions, and over time you will build the knowledge and confidence to manage and grow your wealth. Believe me, you can grow wealth over time. The key is to research and understand the companies you invest in. At the basic level, it might be difficult to understand the business operations of a company. Hence, you can opt for mutual funds, which already have professionally managed fund managers who look after your funds for you. However, the pedigree of the fund manager, his track record also speaks volumes, as well as the expenses which are charged. It shouldn't happen that your returns are 20% and you are paying roughly 2% in charges, so your net return is 18%. You will also tend to pay taxes the moment you redeem your mutual fund, that is, you sell off your mutual fund. So these are a few things which we will cover in detail when we cover the topic of mutual funds. Mutual funds typically spread the risk because most of the schemes have a very different set of offerings, and you need to be cautious how you select your mutual funds. How to select mutual funds, types of mutual funds, various items that need to be covered will be addressed in the subsequent session. Thank you.